referring to the GDP, here we refer to the level of the income generated from only the final output of goods and services in that particular country in 1 year. And this can come from the various sectors of the economy, such as agriculture, we have mining, we have, for example, tourism, we have transport, and so on, depending on the sectors which constitute a particular economy. Then we move to what we call the gross national product. And the GNP usually goes beyond the country in that it involves other activities which could be by the people of the nation, but now outside the country. For example, we are talking of the relationship between exportation and importation in a particular country, where we now relate our people's performance with what is happening outside, but now having an effect on the income of the country. Like when we are importing, it means there is an outflow of the income from our nation to other countries. When we are exporting, it means there's an inflow from other nations to our country. And we cannot avoid to constitute such income, which is actually from abroad, or rather the net income from abroad, because this will actually have an effect on to the nation's income at the end of a particular period of time, or within that particular 1 year period. So when we are talking of the GDP, we talk about the gross domestic product plus the net income from abroad. In other words, the difference between the importation and the exportation in the country. A question that we may ask: why is it that in a nation, why in most, let's talk about less developed nations, the GDP, tends to be less than the GNP? Because you'd expect that if you are to add something to the GDP, that is the net income from abroad, to arrive at the GNP, then the GNP would actually be higher than the GDP. But why is it that in most less developed nations, the GDP tends to be less, or rather the GNP tends to be less than the GDP in a particular country? And one of the major contribution is out of what we normally export and what we import. Looking at the importation in a country like Kenya, you realize that we import most of the industrial products. These are expensive. Versus what do we export? Mainly agricultural products. And how much does this fetch from the market? The market prices being very low, then it would mean the output generated from such products would actually be low. And this is the income you're waiting now to actually buy the imports. And if there's an outflow that is higher than the inflow, then it would actually offset the value that we are calling the GDP as we arrive at the GNP. And again, if you are to look at the elasticity analysis that we talked about in our topic of demand and supply, most of the products that we are dealing with, they tend to have less elastic kind of supply. How long do you wait for an agricultural product, for example, to be ready for the market for sale? A long period of time, which means by the time we are hitting to a higher level of output to be sold to give us higher level of income, it is taking too long. Versus a nation that is in relation to the production of industrial products, which is actually producing in masses within a short period of time. So if you are to evaluate how much we are able to generate from our exports, then it would actually be very low versus what we are actually importing from other nations, where there's a larger value that is actually as an outflow from our country. So in relation to that, we end up having a GNP that is less than the GDP. And other factors would be, for example, national the national output being mainly agriculture. Definitely is highly affected by such climatic and weather conditions. And as a natural force, then you realize you have got no control. Then you end up producing an output that is actually less, which leads to a low income to be generated at the end of the sale of such an output. Then we have another term we call the net national product. And this is actually a question we throw to ourselves. When we have produced that output we call final, yeah? And we also bring in the relationship between the exports and the imports to arrive at the national income from abroad or the net income from abroad. We ask ourselves, what was used in the production of these products? And we cannot forget about what we call the capital goods. The capital goods, also known as the producer goods, are such products used in the production of the consumer goods, or what we'll now call final, which will go into the market for sale. However, these products, in your accounting, you call them the fixed assets. They go through the tear and wear. Accounting, we say depreciation. And that loss of value, needs to be replaced. We need maintenance, for example, of our machinery, maintenance of the motor vehicles, repair of our buildings. So to give back to these goods, which are calling producer goods, to allow us to have a continuous production, we have to allow for depreciation. So that depreciation allowance needs to be taken away from whatever we have already generated. Therefore, in arriving at what we call the NNP, we take away the depreciation allowance from what we call the GNP. And this is just to give back. Yes, the capital goods has given us this level of output. However, for us to have a continuous production taking place, we have to give back. We have to maintain such goods so that tomorrow we can have a continuous production taking place in the country. In the name of that, we have to subtract the depreciation allowance from the GNP in order to arrive at the NNP. So these three terms are actually connected. How? Number one, we have said GDP is the amount of income generated from the final output, that is from the various sectors of the economy. And when we are looking at that particular output, we don't include the intermediate goods. Intermediate goods are such products which are basically to go through another process. They are not yet final. So when we account on the intermediate goods, like in the costing, you'd say the cost of production in relation to the materials, in relation to labor, and so on. Such, you'll be doing what we call double accounting. You'll have accounted for the cost and the same time accounting for the price. So we don't include the intermediate goods in the analysis of the GDP, only the final output whose market prices are aggregated to arrive at what we call the GDP generated from the various sectors of the economy, such as we have agriculture, we have what we call transport, we have the trade and commerce, depending on how many sectors are there in a particular country. The GNP, we have said, this talks about the income from within and outside the nation. And we are now constituting the relationship between our country and the rest of the world, where we talk about the difference between, for example, our exports and the imports. However, we are looking at a nation, for example, Kenya, an example of a less developed nation, where we realize that most of the years we have our GDP being higher than the GNP. Our expectation is that if you're taking the GDP and we are adding the income from abroad, yeah, we would have the GNP being higher than the GDP. However, that is not the case for most of the less developed nations. And I've said most of the factors we can talk about are connected to our nature of the exports. Being agriculture, they are affected by the weather condition or climatic conditions, which have got no control over. We also have issues to do with elasticity of supply, which tends to be less elastic, taking too long to respond to the prices in the market. And generally, that would actually fetch poor income at the end of the day. Also, if you're to look at what we normally import, basically being the industrial products, they tend to be of a higher value, and so our outflow outweighs the inflow. Then, in the production of the goods and services in a country, we require what we call the capital goods or the producer goods. And when that production is taking place, there is a tear and wear of this particular product. We have to allow for depreciation to have a guarantee for our production tomorrow. So that depreciation allowance, also called from your accounting the capital consumption, yeah, it is normally subtracted from the GNP in order to arrive at what we call the net national product. So when we are doing the calculations, we follow the procedure that the GDP is arrived at the sum of all the productions which are leading to final output of goods and services in the country from the various sectors of the nation within 1 year in a country. The GNP is that particular income arrived at the GDP plus the net income from abroad, all plus the difference between the exports and the imports. And then to come up with the NNP, we take our GNP and we subtract the depreciation allowance or what we could be given as the capital consumption in the country. We'd also want to understand the following terms. One is what we call the national income, measured under what we call the nominal income, versus what we can call the real income in the country. I would introduce this in terms of what we call prices, the market prices of goods and services in the country. And when we are looking at this, we would want to have two periods of time. One is what we call the current period, the period to which we are measuring our national income, and we would want to have what we call a point of comparison usually a year before what we call the current period. Let's say the year 2000 as our base period, the point of comparison, and we have what we call the year maybe 2019 as our current period, the year to which we want to establish the national income variable. So the nominal income basically sounds like a very big variable. It is in money terms, usually expressed in terms of what we call the current prices. Like if we want to come up with the nominal income for last year, 2019, we would actually measure our output, the various products that we have produced are based on the prices for the year 2019. For sure, 2019 prices of goods and services must have been higher than the prices during the year 2000. So our figure will be looking as it is a very big variable. But what is making such a figure to be high? The rate of inflation. Between the year 2000 and the year 2019, prices of goods and services have been increasing in the market. And when that inflation is experienced in the country, it would actually mean that the prices would actually be very high. And if we are to evaluate our figure based on such high prices, then the result would actually be high also. So nominal income or nominal value of our national income is actually measured in terms of money terms, which means very high because the prices of the current period would actually be high. And these are actually as a result of the inflation experienced in the country. The real income is that income based on what we call the prices of the base year. For example, we would want to evaluate the income based on prices which are not actually affected by the inflation. So when we talk of the real income, we have taken away the rate of inflation from that particular measurement, such as real income, if it is evaluated, it tends to be less than what we call the nominal income. I repeat, when we are evaluating the nominal income, this is based on the money terms, based on the current prices of the period to which we are evaluating the income for, such that such high prices evaluated in the current period tends to be higher than the prices based on another previous period. So during the current period, if prices are used in the measurement of the national income, then such income will tend to be high. In the real terms, we evaluate our income based on prices where there is no effect on, or rather the effect coming from the inflation. In other words, the inflation rate has already been taken care of, and such prices would actually talk about a particular income that is much more stable, because in the real terms, when it comes to you spending in a particular nation, you'd think of, let's say you have 2,000, but how much can the 2,000 obtain? If you're to measure your basket, you realize that the basket will be affected by the prices of the goods and services that you're going to put in that particular basket. So its value, will be measured upon what are the prices of the goods and services that you want to put in that particular basket. So if prices are high, then it would mean your basket is going to be very small. But if prices are low, then the amount of goods and services you can put in the basket will tend to be high. So when we are evaluating our national income, the question is, has there been inflation in the country? So if imagining we were to take away that inflation, what would actually be the actual amount evaluated out of a nation within that 1 year as the income variable? Okay? So when we are looking at the real income is measured upon the prices from the base period, the period of your comparison, and these prices are assumed to be constant. Therefore, the rate of inflation has actually been taken away. So how do we adjust now the national income we are calling nominal to now evaluate the exact income that we can call real income? To do so, this is what we consider. We inflate, or rather we deflate the nominal income. We deflate the nominal income using the price index to arrive at the real income. Real income is actually evaluated as the nominal income. You consider the price index. Price indices are normally evaluated based on the base period, and you deflate that nominal income so as to arrive at the real income. In your calculation of the real income, that is from the nominal income, when you deflate the nominal using the index number, you should always get a real income that is less than the nominal income. Remember, nominal is usually a higher value which is expressed in terms of the current prices of the goods and services in the country. And because such prices contains the rate of inflation, then it would mean nominal value would tend to be very high. But now we want to question, what if such rate of inflation were to be eliminated? What would be the exact value of the income in the country? And to arrive at that level of income we call the real, we want to take away that rate of inflation, and to do so, we are deflating the nominal income using the price index, which are based on the two periods of time, the current period as well as the base period, so as to arrive at the real income. And so real income will always be less than the nominal income. Many instances, when you're given the GNP, that GNP would be nominal, and you're asked now to compute the GNP as under the real national income. And to do so, you deflate the nominal GNP, or the one that you'll have calculated, using the price index provided, so as to arrive at the real national income. And I've said index numbers are normally computed between the current period as well as the base period. Base period is normally the period of time used for comparison purposes. Like I would want to say between the year 2000 and the year 2000 and maybe 10, prices of goods and services have been increasing, let's say, by 10%. That 10% can actually act as our price index. Okay, and index numbers are usually expressed in percentages. That's why in the calculation of the real income, we take the nominal income, divide by the price index times 100, so that the 100 can take care of the price index, which is usually expressed in percentages. In our next meeting, we'll look at the three methods which are used in the calculation or the estimation, because sometimes you're not able to come up with the actual value of the NI of the nation, so we just call them estimates. And the three methods that we are going to look at do constitute the output method, also known as the production method. Number two, we have the income method. And finally, we have the expenditure method. And each of the three would want to evaluate exactly how we compute the level of income. But as I say, they're just but measurements, but later would expect such estimates to actually be talking of almost the same value, although not exactly the same at the end of the day. We stop there. We'll have a look at other components of the NI in our next meeting.